I'm happy to have you. Welcome, Neclesia. Welcome. All right, just waiting for some additional persons to join, then we can get started. As you join, I'm just asking you to share the live with someone that you believe can benefit from the information that we will be discussing this evening. We are going to be looking at the 3 C's of credit worthiness. And in so doing, we're going to look at what do financial institutions consider when they're assessing mortgage clients for financing, and how can you increase your readiness or your chances of qualifying for a mortgage by getting equipped with this first-hand information. So as you join, I just invite you to share, like the live, comment below, let me know where you're joining from. Okay. Able to see me? Are you able to hear and see me clearly? Okay, thank you. All right, I'm just trying to get the video up and running. Just give me one brief minute to figure this out. There we go. Welcome, Lady Neclesia. Welcome, everyone. This evening, I just want to welcome you to Hone It to Own It, your weekly home buying series where we empower you and we equip you with the tools and the knowledge necessary for you to come into your journey of home ownership. And so tonight, specifically, we will be looking at the 3 C's of credit worthiness. And what does that mean? There are some key factors that financial institutions consider when they are assessing a client for mortgage financing. I think there's some background music here. Let me just see how I can get this off. All right, there we go. So there are some critical factors that mortgage financing institutions look at when they are assessing whether or not you're eligible for a mortgage. And so whether you're located in the United States or you're based in Jamaica, we're going to be deep diving in what are those factors that you need to be aware of and that you need to adequately prepare yourself for to position yourself to become a homeowner. And so, just for introduction's sake, I am Kimon Tobias. I am a certified Wire to Win DNA coach, a realtor, and former banking professional with over 15 years of experience with a specialization in mortgage financing. And so I have a desire and a deep passion to really help persons to equip them with the knowledge, resources, and everything necessary to come into one of the best assets or investments I believe anyone can make in their lifetime, which is real estate. And so, as I mentioned before, we're looking at the 3 C's of credit worthiness. What is it that you need to consider as a prospective home buyer when, particularly for those who are seeking to get mortgage financing to purchase a home or land? What are some of the things that you need to be looking at in that preparation process? And so I've broken it down. I like, ABC is very simple. So we're doing the 3 C's of credit worthiness this evening. And so there are some other factors, but these are specific to the client. And so I want to help you to properly prepare and position yourself that you are able to do the necessary legwork before you go and you sit before a mortgage financing officer sometimes that discussion can be a bit embarrassing. So I want you to, do some preparatory work to lay the groundwork, the foundation before getting to that stage. And so the first C I'm going to be looking at this evening is capacity to repay. What does that mean? In short, how much home can you afford? Now, there are different terms that you will hear going around in the banking sector. You'll hear, for example, debt to income ratio. You'll hear debt servicing capacity. You will hear total debt servicing ratio. What this simply means is, of your total gross earnings, what additional burden do you have to take on a mortgage payment? And so there's some things that we can do to assess this personally. And it's a very simple calculation, and I'll help you to do your own self-assessment this evening so that you can start checking, how much home can you afford. So what we'll be looking at is what the monthly payment is that you're able to, add on to what you're currently spending on a monthly basis, or what your monthly expenses are. And so some of the things that we look at, or that the financial institution looks at, is first they set a threshold. What percentage of your salary do they believe is comfortable for you to manage, debt servicing? And debt servicing will include facilities or obligations such as if you're going to be paying a rent, even after you've acquired a property, they would consider that. Or if you will still have some form of commitment towards home arrangement. So whether that is you already have a mortgage and you will continue to have a mortgage after you've sought this additional financing. Are you paying rent, and will you continue to pay rent after you've sought this mortgage financing? Or if not, they'll be looking at other factors. So what kind of liabilities, monthly loan obligations do you have? What's your card balance, and what's the minimum payment monthly that you have to commit to based on, the average balance on your card? Generally, if you're not sure what that is, they will use a percentage of the limit, generally 3 to 5% of the limit. So that's something that if you're not sure on average what your credit card balance is, you can use 5% of your credit card limits when you're doing this calculation. Outside of credit card obligations, do you have any personal loans, student loans, car loans? What's the total monthly commitment that you make towards those personal debt obligations? So we're adding all these components together. Your home contribution, and you will add this factor only if that will continue after you've acquired a property or the mortgage that you're seeking. You'll add your credit card payments, and you can start by doing 5% of each of your credit card limits as an estimated monthly commitment. And then you'll also look at what personal monthly loan obligations do you currently have that need to be factored as a part of your debt to income ratio. Once you've added all those expenses, now we're going to divide that by your total income before taxes, which we also call your gross income. Now, after you've done that calculation, you're going to times it by 100, and the percentage that you get currently will indicate what's your current financing capacity. All right, so that's how much you're paying. Ideally, before you assume a mortgage, that figure should be well below 40%, because as I indicated, most financial institutions with a mortgage commitment, they will cap that threshold at 40% of your income. So if you're edging on 40% or higher, it simply means that you will have some more preparatory work to do in reducing your obligations, your monthly obligations, to create more capacity to repay a future mortgage. And so that's the first component. As I mentioned, we're looking at the 3 C's of credit. And the first one we're starting out with is capacity to repay. And I just gave you a simple formula how to calculate your capacity to repay, meaning how much can you afford on top of what you're currently earning, to do that temperature check And as I mentioned, you're trying to get somewhere, in the 20-25% and below, so that you have sufficient capacity to take on a mortgage payment. Now, there's an additional component to it, but I won't complicate that tonight. If you would like to get your one-on-one self-assessment done, you can engage me for a one-on-one coaching session. I usually provide a free introductory session to all clients. So I'll definitely share the link on my pages so you can get signed up to do your free introductory session with me, for me to help you in terms of deciding these factors. How much can you currently afford? And what's the amount that you need to have in place in order to get the mortgage or the financing amount that you so desire. The second C, so now that we know how much home we can afford, meaning what's the monthly payment we can realistically afford to commit to based on our income. Before I move on to the second C, now it's good when we have this information because it also helps to inform our next steps. So perhaps you do that assessment and you're 40% or over. It means therefore that there's some, there's some instruction there that you can take from it. So either you will need to look at reducing your debt obligations, a loan consolidation, paying off some of those debts before you think about getting the mortgage, or you may need to look at increasing your earning potential. And so that's a tricky topic. We won't go in that tonight. That we'll leave that for another night. But those are two ways in which you can help to balance your affordability. So either bringing your expenses down or bringing your income up. And that's, as I said, we will look at that at another week. Different ways that we can improve our eligibility for financing. And so we move into the second C of credit, which is capital. Now, capital, simply put, is knowing how much you can afford. That will dictate the size mortgage that you're able to qualify for. Now, there will be some necessary costs that you will have to bear out of pocket in order to satisfy the bank that you're able to finalize the transaction. Now, when purchasing a home, in most instances, you will be required to make a down payment, a deposit to the vendor, the person who is selling the property. On average, this ranges. So for my persons in the US, depending on if you're using, specialized down payment assistance programs, you can find a minimum down payment of 3.5%. If you're seeking to do a conventional mortgage, then you're looking at about 20% of the purchase price is what you'll need to find for your deposit. For my folks in Jamaica, this figure too varies largely. So particularly for lower income housing and government funding housing solutions, you're looking at about 5% to start. So whatever the house is being sold for, you will need to come up with a minimum of 5% of that amount. The average that we see in the market is about 10%. Some developers may ask for more, so you may find persons asking for 15% in some cases. But I think a sweet spot for persons in Jamaica would be around 5% of the selling price. And so, as I said, knowing your capacity to repay will dictate how much you're able to get in terms of financing for a mortgage. That will in turn drive how much you will need to come up with as an initial down payment. Now, as I mentioned, there are ways that we can help to close that gap. But on the front end, you will need to have at minimum that 3.5%, as I mentioned, on the side of US, if you're using a down payment assistance program, or between 5 to 10% for my folks in Jamaica. Okay. Outside of that, there are some additional back end costs. So you will have to pay the deposit upfront in order to sign your sale contract or your sale agreement. Now, towards the end of the transaction, or even before you get there, there are some other costs that you'll need to budget for. And so I'll just give you a brief overview of what those costs are. I won't go in detail. We will leave that for another session. So we're just building the foundation this week by speaking about the client, your ability to qualify for a mortgage. And so In terms of the additional costs, for my folks in Jamaica, these costs will include things like your inspections, meaning your appraisal reports, surveyor's inspections. You'll also need to pay government fees as it relates to registering and stamping and transfers. You'll also need to have bank fees, particularly if you're using mortgage financing. Now, the total amount that I would recommend that you budget to cover all these amounts, all these miscellaneous costs, would be approximately an additional 5 to 7% of the property price. Now, next week, we're going to look at down payment assistance and closing cost assistance. So I'll look a little more in terms of where are sources of funding that you can pull from in order to reduce your out-of-pocket burden to finance those back-end costs, which I mentioned, your inspections, your closing costs, legal fees. But at minimum, as I mentioned, when it comes to the second C, which is capacity, you will need to be able to find at minimum your down payment, which is, again, 5 to 10% for my folks in Jamaica, minimum 3.5% in the United States if you're using down payment assistance programs, or in some cases, you may have to find up to 20% if you seek to get a conventional mortgage. Now, on the back end, as I mentioned, the closing costs, inspection costs, bank fees, you're looking anywhere between 5 to 7% of the purchase price to cover those costs, right? And so knowing how much you can afford, you will be able to do that kind of calculation to see what is the cost that you'll have to, be able to save towards before you undertake or you embark upon your home ownership journey. And there's a scripture that I love so much. It says, which of you, before you begin to build a house, will not first count the costs? And so what we are learning tonight is how to count the costs, how to ensure that you don't undertake a commitment or an obligation in going and, purchasing a home, going ahead, signing a sale agreement, and you're not properly prepared. So just for recap, we looked at the first two C's of credit worthiness. The first one was capacity to repay, which is simply put, how much home can you afford? The second one we looked at is capital. How much money will I need upfront in order to undertake this transaction? And the third C of credit worthiness I want us to explore tonight is character. And character simply means, what's your reputation like in the banking sector? What's your credit history? If you were to go into a financial institution today and they pulled a credit report, what would that credit report say about you? Or if you have no credit relationship, what does your existing banking relationship in terms of consistency in savings, how long you've established a relationship with the institution that you're considering to get financing from, what does that relationship look like? Now, the truth is, especially if you're going to an institution that you don't already have a relationship, a credit relationship or a banking relationship with, consider it similar to someone coming to you, just a random person, and asking you to lend them $15 million. Now, if you don't know this person, chances are you're not going to lend them any money. And so some of the key things that I want you to consider or to start working towards in developing your character is trying to look around from now in terms of mortgage rates. Which financial institution do you think you're most inclined to seek financing with? If you don't already have a banking relationship, I'd encourage you to go in and at minimum open a savings account. Start sending funds there to a savings account consistently. Develop a savings history with the institution that you're intending to get financing with. It will work for you in the long run, because one of the things in the back end, there are different factors which the banks use to derive a customer's score. And that score in many cases determine, for example, maximum percentage financing you're able to get, your risk rating as a customer. And that has to do largely with the tenure of your banking relationship And in addition to the tenure, the nature of that banking relationship. And so, as I mentioned, if you're seeking to get financing from a particular institution, it's good to establish a relationship with them, whether it's on the credit side or on the savings side. So start having funds going to that institution consistently. Welcome, welcome to the live, Lady Regina. As you join, I just ask you to share the live with anyone that you think this information can be useful to. This evening, we are looking at doing your own self-assessment in terms of eligibility for mortgage financing. And there are three components that we're considering. We're looking at the 3 C's of credit worthiness. And so far, we've covered the first C, which is capacity to repay. How much mortgage can you afford, or how much home can you afford? We also looked at the second C of credit worthiness, your capital. So how much money will you need to have in order to finalize the transaction outside of the financing or outside of the funding that the bank or the mortgage brokerage firm is willing to give to you? And so we're now looking at the third C of credit worthiness, which is character. And so I was mentioning that there are different things that the banks or financial institutions use to assess your character. Tenure of banking relationship is one. They also look at the nature of the banking relationship. So do you have a consistent savings history? How much money do you have in terms of savings or investments with them? They also look very importantly at your repayment history or your repayment pattern, which we know as credit history. Now, credit history is very, very big. It's one of the most critical components. So you can pass the first 2 C's. You have the capacity to repay. You have established your capital, and you can still not pass on to getting financing because of this third C, the character component. And so I want to encourage persons, especially if you do have facilities that are in arrears, go in. Don't be evasive. Don't avoid your lenders. Go in and speak with them. See how best you can establish a set repayment plan to clear whatever arrears, because as I mentioned, your character speaks volumes. So if you have a default, but they see that you have a commitment to repaying the debt, that will actually count for something. So go in as soon as possible, whether it's student loan or whether it's a car loan, a personal loan, a credit card debt that may be past due, or maybe even in severe delinquency. I suggest that you go in and you establish a payment pattern, because there are facilities or there are measures in place where if you've demonstrated a consistent repayment period, and each institution or each jurisdiction has minimum tenures that they consider as acceptable. So if you are repaying that debt for that stipulated timeline, then it will still allow you to access credit once that timeline has passed. There's a statute of limitation. For persons who may have more severe cases, you may have a severely delinquent facility that has gone more than 90 days past due, which means it's now in what we call non-accrual status, meaning they're no longer able to collect interest because it has gone past the interest bearing timeline. In those cases, there are statutes of limitation that they're governed by on the national level, which usually stipulates that if you clear that debt, then after 7 years, you should be able to access additional credit. So as I mentioned, don't just leave the debt hanging and ignore it forever. Still try to go in, establish a payment arrangement, because you never know, that timeline will pass and you will then in the future be able to access financing. So that's something I wanted to mention. And so just wanted to recap, we looked at the 3 C's of credit worthiness. How can you properly prepare yourself to undertake or to embark upon that home buying journey? Following these 3 self-assessment tools, looking at how much home can you afford? And for those who missed it, I encourage you, the video will be uploaded on YouTube. You can go back and watch it. How to calculate how much capacity you have to take on additional debts. If you want a one-on-one consultation with me where I can help to break it down and actually convert that monthly payment into a mortgage financing amount, then I'll also post the link in my bio, and you will be able to schedule your free one-on-one consultation. So the preliminary consultation is free, but the subsequent consultations are at a cost of 5,000 Jamaican dollars and 40 US for my persons who are over in the United States. After you've looked at how much home you can afford, what's the monthly payment in terms of debt obligation that you can afford to take on for a mortgage, the next thing you want to assess is how much money do you need to put down upfront and on the back end to finalize that mortgage transaction and close the deal. Now, again, I mentioned that this ranges between 3.5% to 7% for my persons in Jamaica. You need to have a minimum, rather, I'm speaking about the US. So for my US folks who are using down payment assistance programs, you will generally, be required to have a minimum input of 3.5%. Or if you are an active duty or a retired soldier, veteran, you also have veteran assistance programs that can help you in terms of minimizing your upfront costs. As it relates to back-end fees, bank fees, inspection costs, closing costs, you're looking at between roughly 7% on the back end to cover those fees. For folks in Jamaica, deposit, you need a minimum of 5 to 10% for your down payment costs. For closing fees, you're looking at between 5 to 7% to cover all those transactional costs I mentioned just now. And once you have that put, you also want to assess your creditworthiness, meaning your character. What is your tenure like with the financial institutions, primarily the financial institutions that you may be seeking to get funding from? What's the nature of that relationship? Are you consistently saving? Do you have a borrowing history with them? Do they know you in a financial sense? And last but not least, your commitment to repay. So how are you currently repaying the debts that you already have, whether with the financial institution you're interested in getting funding from or with the other institutions? And so if you don't know, particularly for my folks in Jamaica, well, folks in the US, you can always access your free soft pull Equifax report, and that can give you an idea what your debts are, your repayment history. So before you even go in and speak with someone, you can do your own preliminary assessment to see if you may need to go in and speak to set up some special arrangement with any financial institution to resolve any repayment issues you may have. For my folks in Jamaica, we have two credit bureaus. We have the CRIF Credit Bureau, and we also have the Credit Info. And as a customer, you're entitled to one free credit check annually. And so you can go in or call, send an email. I've had clients send an email and they'll walk you through the steps of requesting that free credit check. So you can just do a checkup to see, if there are any loans which may be settled, but they're still reporting as opened, or any facilities you may have forgotten about that you need to go in and set up a payment plan on, so that when you get to the point of, deciding on buying your home, there will be no obstacles. You will be unstoppable because you have already conducted your own preliminary assessment. Now, before we go, I just want to recap, if it is that you want to get your one-on-one, individualized, customized pre-assessment, you can consult with me. As I mentioned, my first consultation for all clients are free. And after that, it's 5,000 Jamaican dollars or 40 US for my folks located in the United States. I can help you to get a preliminary pre-assessment to see how much you can afford, what are the costs that you will need to save towards once it is that you've established how much home can you afford. And I also provide a financial planning roadmap to help you to get to that desired goal within your specified timeline. Next week, share the live. We're going to be looking at down payments and closing cost assistance programs for my folks in Jamaica and the United States. You can't afford to miss it. So I just encourage you to share the live Go on and watch it on YouTube for those who missed the initial parts of the live. And God bless you, and you have a great evening. I just want to ask before I go, if there are any questions that you have coming out of this session, you can just share them in the chat. Let me know, what's your major learning or your major takeaway from this evening's session. So just send up some comments and let me know what particular aspect you found insightful. Have you learned anything new? And what was the major learning for you? So I just want to welcome Lady Farah, welcome Lady Regina, and thank you for joining Neclisa and for your engagement throughout the session. All right, so we have no questions. It seems like everything was crystal clear. All right, God bless you, everyone. Have an amazing evening, and we'll see each other again next week, same place, same time. Join in and let me help you to hone it, to own it. Have a great evening.